Welcome to Arcimoto! These cars are fun! I love this! This is so cool!
Oh, Kevin. Kevin, what have you done? Arcimoto, since that video was made, has collapsed 98%. Welcome back to Strongman Personal Finance. We're going to do a little bit of catching up with good old Arcimoto. Because I remember I was very critical of Kevin, about a year and a half ago, when he interviewed the CEO of this company, it looks like. And he did a video driving around in one of these little soy boy vehicles and shilling it on his channel. So if you don't know what Arcimoto is, basically they make a bunch of, like, I would almost call them meme-worthy electric vehicles, okay? We could actually look at them now. So they have the flagship vehicle. It's like this dorky, fun utility vehicle. It's called the FUV. You have a roadster. You have a deliverator. You have a lean, mean machine, a rapid responder, blah, 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 blah. Basically, they provide dorky-looking electric vehicles for fun or for, uses within a city. Like, oh, if you need if you want your police force to be driving around in these to, I don't know, intimidate the local bad guys. So it's a cool concept, right? But if you actually look at the fundamentals of this company, it's an investment disaster, okay? I wouldn't be surprised if this company goes absolutely bankrupt in the next year. So I'm a huge fan of looking at financial statements, right? Now, the first thing I do when I look at a speculative company like this is I pull up the 10Q and I immediately type in going concern. Type that in. Control F, going concern. Going concern is an assumption that a company is going to continue its operations indefinitely. That's one of the fundamental assumptions of accounting, is that you have, a certain valuation or certain, numbers on your balance sheet because you're assuming the company is going to last forever. Now, if you were valuing a company as if it was about to be liquidated, you would probably change some of the values on the balance sheet. You'd probably look at it from a liquidation value standpoint. But that's one of the fundamental assumptions of accounting. When there is doubt about a company's ability to continue as a going concern, you can read that. Sometimes that pops up in the auditor's report, or sometimes the management mentions it. That's a bad sign. Okay, so if you type in going concern and you see some information here, you see some text, you should read it and you should be a little bit worried. And this is before we even look at the financial statements, okay? The financial statements have been prepared on the basis the company is a going concern, which contemplates the realization of assets and satisfaction of liabilities in the normal course of business. The company has incurred significant losses since inception, and management expects losses to continue for the foreseeable future. And then they go on and talk about how they're, reaching agreements to issue more shares and go into debt. But we can see all that in the financial statements, right? So let's go ahead and look at the balance sheet. So we have a comparative balance sheet here. We have December 31st, 2021, and we have September 30th, 2022. So this is a total of 9 months, comparing from right to left. So we could see, number one, a massive incineration of cash. That doesn't necessarily mean it just poofed into thin air or was consumed in operations, but there has been a massive deterioration in cash. They had almost $17 million of cash. Is this in thousands? No, that's in actual numbers. They had $17 million of cash on December 31st, 2021, and that's dropped all the way to $4.2 million in cash. So they burned, oh my God, $12 million of cash in 9 months. Well, we'll see. Accounts receivables has gone up. Either that's from increased sales or they're having issues collecting from people they're selling to. You have to look into that more. Inventory, the actual products, has gone up by about almost 50%, more than 50%, okay? That could be an indication that they're just buying a lot of inventory or producing these things in the anticipation of selling them, or it could mean they're having trouble selling their products. Could be, because these things are expensive and the semi-checks are running out. Prepaid inventory's gone up a little bit. Nothing crazy there. And other current assets, don't know what that is almost doubled. So net, they burned about $5 million of current assets. Now, I like to compare current assets to current liabilities. And specifically, I like to compare the cash and cash equivalents. You can almost call it the quick ratio, which is cash, cash equivalents, accounts receivable, and short-term investments. Things you could convert to cash very, very, very quickly. I like to compare that to current liability. So I'm looking at this and I say, okay, well, total current assets are 25 million, but half of that, more than half, way more than half, seems to be in stuff that you may have trouble converting into cash quickly. And when you have short-term debts coming up, you want to make sure you have cash to pay for it. You see what I'm saying? So let's say, yeah, let's exclude inventory, prepaid inventory, and other current assets. So they basically have $4.5 million of cash and cash equivalents. $4.5 million. Let's compare that to their current liabilities. Bills due within a year. $19 million. So they have $4.5 million of very liquid cash, and they have $19 million of debt due in the next couple of years, or in the next year. We can see they have $7.2 million of accounts receivable, accrued liabilities. Their accrued liabilities, which is when you expense and record a liability when the transaction occurs, not when the cash is paid, is actually more almost than their liquid cash. So their short-term debts that are coming due very quickly, it's bad, okay? And look here, short-term convertible note. It looks like they went into $8.6 million of debt in the last 9 months. That's due within a year. They're going to have to pay $8.6 million of debt or refinance it, probably at higher rates because rates have gone up very, very soon. This is not good, okay? Warrant liabilities, whatever, current portion of finance lease obligations, $19 million of short-term debts compared to $4.5 million of very liquid current assets. Now, the current ratio looks better if you include inventory and prepaids. It's actually over 1, but are they really selling their inventory? I don't know. We'll see, okay? Let's look at long-term assets and compare that to long-term liability. So they've definitely invested about $5 million in property, plant, and equipment. Their intangibles have gone down, probably amortization. Deferred operating costs, insignificant, gone. And operating lease right of use assets. So basically, they're buying more property, plant, and equipment. They're spending more on it. And they're recording some leases on their books, okay? So they've actually increased their total assets, their total long-term assets by a decent amount, okay? Let's compare that to long-term debt. So their long-term debt consists of finance leases, equipment notes, convertible note, which they just issued long-term debt here too. You need to see when this is going to mature. $4.8 million of that. They have a total of $7.8 million of long-term liabilities compared to way more long-term assets. So when you compare the long-term assets to long-term liabilities, the whole thing isn't that bad. They have more of a liquidity issue, potentially not being able to pay their short-term debts than they do being massively underwater on their long-term assets. At least that's good. So it seems like they probably bought all of their long-term assets with cash. We'll see, okay? So, let's see. Total liabilities has absolutely exploded. It's gone up by $17 million, so they're packing on debt massively. And their total assets has gone up by $1 million, okay? So, $17 million of debt up versus basically a little bit more than $1 million of assets. That's pretty bad, okay? You usually want your assets to be going up and your debt to be going down or staying stable. All right. Let's see. Common stock has gone up. They had a share issuance. Additional paid-in capital has gone up. Accumulated deficit, their accumulated profit and loss since inception, has gone more negative, so they've had massive losses, okay? Let's look at their profit and loss. So right off the bat, I don't even need to do any more research on this, okay? This is absolute trash. Look at the 3 months ended September 30th and the 9 months. They have a negative gross margin. Negative gross margin. So the cost of the actual vehicles that they're selling, whether they're manufacturing them or whether they're buying them and then reselling them, is more than what they're selling them for. It's probably because of a very large fixed overhead, is my suspicion. But for every vehicle they sell right now, they're selling that at a loss because they have massive, probably fixed overhead expenses that they're not generating enough volume to overcome. It's a disaster, okay? I mean, look at this. Research and development. So revenue has gone up, okay, maybe 33%. R&D has doubled. Let's see. Sales and marketing has not doubled, but it's gone up pretty significantly. General and admin has gone up by 33%. Their total operating expenses have, I would say, almost doubled. So their operating expenses have grown faster, it looks like, than their revenue. Oh my God. Okay, unrealized gain. They had a gain on a convertible fair value note. Okay, that's like basically fake. And their loss. So they had a $16 million loss on $2 million of revenue in the last 3 months. Almost $17 million loss on $2 million of revenue in 3 months. That's god awful. And if you look at 9 months, they had a $47 million loss on $4 million of revenue. This is awful. Absolutely trash awful. Okay? Let's go look at the statement of cash flows. So we can see cash flows from operating activities they've burned $40 million of cash from their actual business operations. And we can also see something I noted here, stock-based compensation. Almost $5 million of stock-based compensation in the last 9 months. And look at their revenue. $4.1 million. So their stock-based compensation expense is higher than their revenue. It's freaking nuts, man. So they burned $40 million of cash. They spent $9.3 million of cash on property, plant, and equipment. A little bit on security deposits, insignificant. So they burned $40 million from operations and almost $10 million from capital expenditures. Where did the money come from? Well, they got $27 million of cash from issuing common stock. They got a little bit from warrants, stock options, proceeds from equipment notes going into debt, and convertible notes. So basically they got $27 million of cash from stock and over $14 million from going into debt. So this company's literally surviving by going into massive debt and issuing stock. And they're burning cash at an insanely high rate. And their stock-based compensation expense is higher than their freaking revenue. And they're selling every vehicle at a loss. This thing is an absolute disaster. Okay? Step bro. I just wanted to follow up with you. I'm disappointed in you. Okay? You should know not to shield stocks like this. But I forgive you because you pay me $2,000 a month. So overall, this thing is hot trash. I don't know what else to say about it. I would not touch this thing with a 10-foot pole. It's probably going to zero. It's going to go bankrupt. They're going to be issuing shares. They're going into massive debt. It's just a disaster. But hey, maybe I'll be wrong. We'll see. Cheers.